The big macroeconomic features of the coming week will both hail from the UK, in the form of the latest unemployment and wage growth numbers on Tuesday the 18th of May, and then an update on inflation on Wednesday the 19th. The Bank of England's just cut its forecast for peak unemployment in the wake of the pandemic to 5.5%. That compares to the last reading of 4.9% for February, and even though it does unfortunately mean more jobs could be lost, the good news at least is that 5.5% is a historically low number for a recession. The bad news is that the furlough scheme still needed to support a lot of workers, and the claimant count, which covers those who are not receiving just unemployment benefit but other assistance like universal credit, well, that's rocketed to 2.7 million people. Though again, at least that number looks like it's beginning to flatten out a little bit. The Office for National Statistics will also publish a wage growth figure for March. In February, the rate of increase was 4.5%. The benchmark then will become what will the inflation figures look like the day after, because the comparison between the two is really what counts. And in March, inflation was 0.7% according to the Consumer Price Index, or CPI, 1% according to the CPIH, which includes housing costs, and 1.5% according to the Retail Price Index, although that is no longer an officially recognised statistic. So again, the good news here is if you've got a job, wage growth is outpacing inflation, at least for now, meaning that consumers are better off in real terms. However, lots of economists are looking nervously at increased commodity prices and increased producer price and factory gate prices, as they fear that inflation may be about to pick up. Let's see. On the corporate front, there's a long list of trading updates, interim and final results, and annual general meetings on the schedule. Names which may be worthy of note for what they say about themselves, their industry, or the wider economy include the following, although do note that these dates could be subject to change. Ryanair on Monday the 17th of May, Vodafone Imperial Brands, DCC, Cranswick Britvic and Shoe Zone on the 18th, Experian, Great Portland Estates and Premier Foods on the 19th, National Grid, Kingfisher, Royal Mail, 888 and EasyJet on the 20th, before Young's Brewery and Close Brothers, well, close out the week on Friday the 21st. But for all of those names, the company that looks most capable of causing a fuss in the week ahead is Land Securities. The Real Estate Investment Trust, or REIT, is due to report its full-year results on Tuesday the 18th of May. The shares are up by around a sixth from a year ago, and they've really got a wiggle on since Pfizer Monday, rising by more than 40% since November the 9th, as investors have looked forward to some sort of return to economic normality, with commuters and shoppers alike potentially going back to their offices and the shops respectively. The FTSE 100 member provided a flavour on trading back in April, when it provided an update on rent payments due in the March quarter end, the fourth and final quarter of the REIT's financial year. Now, in sum, 67% of rent was paid on time, or £67 million of the £100 million due in net payments. That was a small improvement on 65% at the same time a year ago. Now, in percentage terms, across the portfolio of buildings and assets, offices did best. Regional retail and the rest of Central London category did worst. For the period overall, from 25 March 2020 to 24 March 2021, 84% of net rents had been received. That gives you some guide also to the company's asset mix, and Land Securities' operational strategy's got four main thrusts. What Chief Exec Mark Allen calls optimisation of the Central London assets is 1. A reimagination of the retail park and retail buildings portfolio is 2. Sale of assets where the REIT feels is subscale is 3, which is predominantly leisure. And then finally, in fourth, growth through urban opportunities, in essence, mixed-use sites and housing. Analysts and shareholders will look for an update on that strategy, as well as comments on the pipeline of new development projects, particularly those 4 sites that they're looking to turn from 100% retail to mixed use, where residential properties will feature heavily, and they include Finchley Road, Shepherd's Bush, Wandsworth and Lewisham in London. Other strategic points of interest will be an update on the £39 million in rent concessions allocated so far to tenants, and also how Land Securities thinks the government's plan to lift the rent moratorium on the very last day of June will play out. This has already been extended once from the end of March, and no doubt many leisure and retail businesses will be asking for more help and more time. Once they've digested this set of big picture issues, analysts will get stuck into the headline, financial data, and 4 key figures in particular. The first is the overall vacancy rate, which ended the last financial year at 2.4%. Note that it peaked at 5.9% after the Great Financial Crisis, and analysts will be asking what will happen in the retail industry, and also looking at offices and whether more people will look to work from home in the future on a permanent basis, decreasing the need for those big buildings. Equally, hot desking could be less common going forward as firms will be looking for more space between workers, so maybe the overall need for space might not change as much as we think. The second headline number is the value of the REIT's assets, a key valuation tool. The European Public Real Estate Association, or EPRA, uses a benchmark called the Net Tangible Value, or NTV. An NTV per share was £11.92 a share a year ago and £10.79 at the half-year stage. The shares are trading at a 30% discount to that, which is one way in which the market's saying its concern about expressing its concerns that future asset values may be going down and that rents could stay under pressure. The third figure is net debt, which stood at £3.9 billion at the first half stage for a loan-to-value figure of 33%. That's not especially high by industry standards, and an average debt to maturity of nearly 11 years offers further comfort here. And finally, analysts and shareholders will look at the dividend. Remember that REITs are obliged to pay out at least 90% of their profits as dividends to maintain their preferential tax status. Land Securities reinstated its dividends with a 12p a share interim payment and then added a further 6p at the third quarter stage. Analysts are expecting a further 5p for the fourth quarter for a full year figure of 23p a share, ahead of a jump to 33p a share in the financial year that's just begun. I hope that you and your families are all in good health and good spirits. Thank you for listening, and I look forward to talking to you all again next week.